Hello, my name is Elliot Gu and I'm editor of Personal Finance and the Energy Strategist. Today I want to talk a little bit about my outlook for the broader market and the economy and the global economy. The S&P 500 is down about 4 or 5% from its spring highs, which really isn't a whole lot when you consider the market deterioration we've seen in fundamentals for the global economy since late winter. In the U.S. we've seen a definite deterioration in the data. A lot of people felt that the U.S. economy was picking up at the beginning of the year. We saw an increase in jobs creation. The first quarter of the year we saw over 200,000 jobs created per month in the U.S. In the second quarter it was less than 100,000. It was about 75,000 jobs a month. That's a pretty remarkable deterioration. Of course, this is something that we've really been looking for since the beginning of the year in personal finance. We've been looking for the data to have been artificially boosted last winter by the unusually warm winter weather. What that did is that actually pulled forward some economic activity. For example, we saw stronger than normal retail sales in January and February because the weather was much better than normal and more people went shopping. We saw more construction activity, more home building activity in January and February than we normally would, simply because people were able to go out and do work on homes, and we're able to go out home shopping. So we saw a lot of that activity that would normally have happened in April, May, pulled forward into the very beginning of the year, and that helped push up some of the data artificially in the first couple of months of the year, and we've really seen that give back since that time frame. But in addition to that, I do think we've seen some weakening in the underlying data. One of the main reasons for that, of course, is concerns about Europe. We've seen the yields on Spanish government bonds spike to record highs. We've seen the yields on Italian government bonds not quite at records. They actually hit higher levels last summer, but certainly spiked back up to levels close to 7% at one point that really are unsustainable longer term. The European Union crisis hasn't been solved. Europe has taken some positive steps forward as a result of their late June summit. In particular, they've agreed that banks can now be bailed out in Spain directly using the European Stabilization Mechanism, which is basically their bailout fund, rather than having the ESM lend to governments who would then in turn lend to banks. So it's basically removing the middleman there. What that does is it severs the tie between the sovereign, the national governments, and the banks and the banking system in a given country. So it is a positive step forward, but it's not a solution. Europe still has a lot of problems. If you look at the overarching data like the Purchasing Managers Index, which is something I watch very carefully in all economies, Europe is already in a recession, and it's not likely to get any better anytime soon for the simple reason that there's still a lot of fiscal contraction going on there. A lot of these austerity measures that the governments in Europe have put in place over the last 6 months to a year are coming into effect, still coming into effect, and that's going to continue to put downward pressure on growth there in Europe. China, I think the outlook there is I'm a lot more optimistic about the outlook there over the long term, but we have seen a market slowdown in that economy over the past year. The thing to remember about that is the majority of that is due to changes in government policy, in particular the Chinese government hiking interest rates and hiking reserve requirements throughout much of early 2011. But we're seeing those policies being reversed, and the Chinese government switching much more to a growth-oriented stance. Over the past month and a half, they've cut interest rates twice. They've also lowered reserve requirements for banks markedly since late last year. So I think the outlook there is a little bit better long term. But in the short term, this summer, we have seen the market rally off its June lows, and again, it's only down about 4 or 5% from its 2012 highs. I actually do see some downside vulnerability for the stock market this summer. We could certainly see a little bit more upside in July. A lot of it depends upon how good or bad earnings reports are going to be. I think we're going to begin to see a lot of managers talking about the potential risks of the coming fiscal cliff, the package of expiring tax cuts and spending cuts that are due to come into effect in early 2013. I also think we're going to hear a lot from managers about Europe and the potential for that to be a source of uncertainty and a reason for companies to cut back on their spending. So none of that's particularly good for stock market or for companies. So I do see some downside for the S&P 500 over the next month or two. Later in the year, I expect the market will see another year-end rally, just as we've seen in the last couple of years. Again, predicated to a great extent on the idea that the U.S., though the economy is not growing quickly and is growing at sort of a 1 to 2% annualized pace, it's unlikely to slip into recession. Another driver of a year-end rally, I believe, will be yet another round of global fiscal and monetary easing. In particular, I see the Federal Reserve instituting QE3, or a third round of quantitative easing, either in August or September of this year. And regardless of what you might think about the effects of that on the economy itself, it does tend to be bullish for risk assets. That includes stocks, higher yielding bonds, as well as, of course, commodities. Now, that final area that I just mentioned, commodities, in particular energy and agricultural commodities, I think that this is a very hot area that is going to be an outperformer in the second half of the year. Looking at energy and oil prices in particular, oil prices have corrected a lot further than the S&P 500. So oil prices are actually already pricing in a lot of this bad news that I just talked about. Obviously, there's a big difference between the S&P 500, which is down 5% from its highs, and oil prices, which are down at one point over 35% from their highs. So I actually see some significant upside for oil prices over the next couple of months, and that should be bullish for oil-related stocks. Some of my favorites remain the master limited partnerships. In particular, these companies are particularly defensive, and they also offer very high tax advantage yields. One area in particular I would look at is the upstream master limited partnerships. These are master limited partnerships and in some cases limited liability companies that are involved in the actual production of oil and natural gas. The opportunity right there is acquisitions. We've seen this from a number of these companies over the last quarter or two. In particular, Lynn Energy, which is a holding in personal finance, as well as the Energy Strategist, and the newsletter I co-edit with Roger Conrad, MLP Profits. The symbol is LINE. This company produces oil and gas, about 50% oil, 50% gas roughly. Their real opportunity, though, has come on the gas side. Though gas prices are quite depressed right now and likely to remain so, the fact is that a lot of companies are looking to sell off their natural gas producing properties to generate cash, in many cases to fund aggressive drilling plans in oil-related basins. So what we're seeing is a lot of these properties up for sale at really low prices. Now, even though gas prices are still quite depressed, trading around $3 per million BTUs, if you can buy a property cheaply enough, you can still make money even at that price, and that's exactly what we've seen out of Lynn Energy. They're already on pace to do a record number of acquisitions in 2012. I think that's going to result in distribution growth for them in excess of 10% over the next couple of years. So Lynn Energy, definitely one to look at. On the agricultural side, again, a lot of this relates to the weather. Over the last couple of months, we've seen a heat wave across most of the U.S. June was a record warm month throughout many parts of the United States. We've also seen a drought. As much as 55% of the United States is currently experiencing drought, or at least mild drought conditions. And that's taken a real toll on key cash crops like corn and soybeans. As of the most recent USDA report, only about 40% of the U.S. corn crop is rated good or excellent condition. Now, that is highly unusual. Normally at this time of year, you'd see closer to 70% of the corn crop rated good or excellent. That's going to severely reduce yields of corn, and don't forget the U.S. is the world's largest corn producer and also the world's largest corn exporter. So that's very key, the conditions in the U.S. To make matters even worse, a lot of the corn crop, the majority of the corn crop has already silked, meaning reached a pollination stage. When you have drought conditions at that stage in the growing process, it's particularly damaging to ultimate yields. The last time we saw conditions this bad was 1988, another drought summer year, and back then corn prices more than doubled off their lows, and I think we could see even bigger gains this time around because corn stocks going into the season in terms of corn and storage were actually a little bit tighter. Similar prospects in soybeans, again, badly damaged by this drought and the extreme heat that we're seeing in a key point in the growing season. So how do we play that? Well, that's actually going to be the subject of your next issue of Personal Finance. But to give you a little bit of a preview, there are a number of companies already in the personal finance portfolios that are involved in the agricultural industry. One of my favorites is a company called Potash Corporation. symbol POT. It's a Canadian company. They make potash, they mine potash rather, which is a fertilizer, a key fertilizer used in both corn and soybean production. Another company in the portfolio is Deere. You probably recognize their green tractors and green lawnmowers, but really most of their business comes from big combines, big tractors that are used on major agribusiness operations. Farm incomes as a result of the rising prices of corn and soybeans are likely to continue to support strong spending on the part of farmers, solid credit conditions, and you're going to see, I think, a pretty good solid year in terms of sales of combines and tractors and that sort of machinery. Another big growth driver for Deere, of course, is their international sales. Traditionally, they've gotten more than half of their sales from North America. They do have a target over the next few years to get more than half their sales from outside the United States, and particularly from emerging markets. And I think they're probably going to exceed that or meet that target sooner than expected. And of course, in farmers in emerging markets are typically using less sophisticated machinery, smaller tractors, and I think that as they trade up to Deere, that's going to be a nice story for their profitability going forward. So in summation, I do see a little bit more downside for stocks this summer, and I think in the short term you want to be a little bit defensive, but I do see some areas of potential upside, and two of those are energy, and in particular stocks leveraged to rising oil prices, and companies that are taking advantage of depressed gas prices to purchase acreage at really attractive valuations. And one company I mentioned there was Lin Energy, L-I-N-E. The second area, which I'll have more to say about in the next issue of Personal Finance, is agriculture. We're seeing a severe drought in the United States, record heat, producing a big hit to the crops, big hit to agriculture. That means upside for prices and upside for companies that sell into the agricultural industry. With that, thank you very much.